So, at the end of last class, I told you that there's something that the Fed controls called the monetary base. And it's defined as, to remind you, currency plus the funds that banks have in their reserve accounts. You can spell that out, reserve accounts. And of course, what does the Fed do? The Fed, among other things, engages in monetary policy. And so we're going to remind ourselves of what money is. It also includes the currency, but in addition to currency, it includes deposits. Now, which deposits it includes depends on which measure of the money supply we're talking about. If this is M1, then the deposits are checking deposits. If this is M2, then it's checking deposits plus savings plus some CDs and so on. But broadly speaking, it's just deposits of some kind. And so monetary policy, the term suggests that the money supply is something that the Fed can control or affect. But what the Fed controls or affects directly is this thing called the monetary base, as we'll see. Well, it can determine how much currency there is by printing it, and it can determine how much reserves there are because, well, these are accounts that banks hold at the Fed. Just like you have an account with Bank of America or something, Bank of America has their own account at the Fed. And what's in it? Their reserves. It's the reserve account. So those are all things that are sitting on the Fed's balance sheet. It can control them. These deposits that belong to you and me, they're not on the Fed's balance sheet. They don't control them directly. So the question that we want to attack today is, clearly the currency is the same currency on both here. The question then is, how is this in any way related to that? And we'll try and answer that twice. Once at a sort of intuitive level, where we should hopefully get a sense for the main themes involved in trying to understand how the Fed can control the money supply indirectly. And then we'll do it a second time in a sort of more detailed way that I hope will demystify this whole question of how is the money supply determined. Okay? So, I guess let's leave that for later. So the first pass at understanding something about how the reserves connect to the deposits, we can do in the following way. First of all, since we're fundamentally interested in this connection here, the presence of currency here is a distraction. There's no action there. So to make things easier, why don't we start by looking at a world where there isn't any currency. Imagine there's no currency. So why are we doing this? This is just something that economists often do. We take a special case, in particular a special case that allows us to focus on what's interesting here. And then when we're done analyzing that, we'll then say, okay, but what if there is currency? How does that change anything here? So for now, let's imagine there's no currency, and it's not that hard to imagine how that would work. It doesn't mean that there's no money, it just means that the money is always deposits. In other words, when you buy something at GW Deli, you don't pay with cash, you pay by swiping a card and money comes out of your account and into theirs, which is exactly what we do most of the time. Similarly, it doesn't mean there's no monetary base, it's just that the monetary base is entirely made up of the funds in the bank's reserve accounts. Okay, so this is just a world of electronic money, basically. So in that world, again, the monetary base is the reserves, and the money supply is the deposits. Now, remember that our window into how the banking system works is the balance sheet. I'm just going to quickly draw up some part of it, the part that we need for this discussion. Okay. And as you know, every bank has a balance sheet. And there is one thing about every single bank balance sheet that is always true here, and that is that the reserves are much less than the deposits. Why is that? It's the case because, first of all, they're not required to hold 100% of their deposits as reserves. And second, they don't want to because they have more profitable things to do with those funds. They can lend them, or they can use them to buy securities that pay them interest or dividends or whatever. So on every single balance sheet, there's some deposits and some reserves. And what are these reserves? These are, well, again, there are two cases. It could be that in this example, the bank is obliged to hold 10% of its reserves as deposits. Maybe it's required. Or maybe it's not required, but this is just what the bank has decided is a reasonable amount as a precaution against withdrawals. So whether it's 10% because it's required or 10% because the bank feels like it, there's some reserve ratio that the banks target. And in this example, it's 10%. Now suppose, since that's true at every single bank, what if I added up all the deposits, all the reserves, all the loans, and everything else across all the banks? Then I would end up with some gigantic balance sheet, but it would still be the case that the total amount of deposits at all the banks is going to be much larger than the total amount of reserves at all the banks. Well, so that's the first observation. In fact, we know how much bigger it's going to be. This is going to be 10% of this. Whether it's required or desired isn't the issue. Now, suppose this is that giant balance sheet that we've added up based on the balance sheets of all the banks. Now observe that on that giant balance sheet of all the banks, the total amount of reserves here are the monetary base. And the total amount of deposits here are the money supply. In other words, we can use these numbers to figure out, well, to see that the monetary base is going to be much smaller than the money supply. Because the reserves are small and the deposits at every single bank. And then this is also telling us a hint about why the monetary base is going to be much smaller than deposits. And the reason is, well, what do banks do whenever anyone brings funds to them? They lend them. And whoever they lend that to spends it. And what happens to that spending? Well, whoever was the seller gets that money, and well, in this, they either hold it as cash, but oh, there is no cash. Okay, so they stick it in as deposits. So this is hinting that the Fed determines how much monetary base there is. That translates into a much larger amount of money. Why? Because the banks take those reserves and lend them. And that lending translates into a certain amount of spending, which then gets deposited again. And so it's the intensity with which banks lend, as opposed to holding reserves, that's related to why this number is so much bigger than this one. So this is our first pass. And so so the way we will talk about this is that we'll say that the money supply is the monetary base times some number called the multiplier, the money multiplier. And that's the connection between the monetary base, which is then expanded by a bank's lending activity to generate a much larger money supply. Now, in the world where there's no currency, it turns out that we can derive exactly a formula for the multiplier. How so? Well, if I divide both sides of this by the monetary base, I get that the multiplier is MS over MB, by definition. And so, in this world where there's no currency, we actually know that the money supply is the deposits. So this is just the deposits. And we know that the monetary base is just the reserves. So we have that. But there's something else we know, which we discussed but I didn't write down. Remember that these banks have some reserve ratio, which in this case is 10% or alternatively 0.1, same thing. And this reserve ratio, again, is either what's required or what's desired. But how do we figure out what their reserve ratio is? Well, we saw what proportion of the deposits is in reserves. In other words, it's just simply the reserves over the deposits. We can see the reserves are 10, the deposits are 100, and that's how we get our 10%. And what's the multiplier? It's the inverse. It's deposits over reserves. So, in the world where there is no currency, what is the multiplier? It's just 1 over the reserve ratio. I'm just going to call it RR for short. Interesting. And notice this has that intuition in it that it's banks' lending activity that's taking the monetary base and somehow blowing it up into a bigger money supply. Because to the extent that you're lending, it means that you're not holding things as reserves. To the extent that you're holding things as reserves, it means you're not lending. So if you decide to lend less, you're holding more reserves, your reserve ratio goes up, so the multiplier goes down. If you lend more intensively, the reserve ratio goes down. What happens to the multiplier? It goes up. So more intensive lending, bigger money supply, even without a change in the monetary base. So this is important for several reasons. One is now we're seeing a little better why it is that, or how it is that monetary base translates into money, even in a world where there's no currency. But there's an implication here. Who determines what the reserve ratio is? Well, to the extent that if we live in a world where banks only hold required reserves, then it's whoever determines required reserves. But of course, there's nothing stopping banks from having more than what's required. This is just a lower bound. So if banks decide that they want to set a reserve ratio that's much higher than what's required, then who's determining that? The banks, not the Fed. So what's lurking here is the idea that, as we'll see, the Fed can fine-tune how much monetary base there is. That translates into the money supply through this multiplier process, but that doesn't mean the Fed has 100% control over the money supply. There are other factors involved as well, and the one factor that we saw here is, well, the intensity with which banks feel like lending depends on them. So the Fed doesn't fully control the money supply. Any questions or thoughts about this first pass at linking the money supply with the monetary base? Right. Then, as I said, we're going to look at this twice. So that's the first way of linking monetary base with the money supply. The second way is we're going to do by thinking about how it is that the Fed actually changes the monetary base, if it feels like doing that. And I'm going to write currency here again for the moment, though we'll soon return to our utopia without currency. And I'm going to say that an alternative way of looking at the monetary base is by saying that these are the things, the currency and the reserves, that the Fed uses to pay for stuff. In other words, whenever the Fed decides that it wants to, let's say, buy something, it has two choices. One is that it can bring into existence new currency and pay for it, and thus they have increased the monetary base. The other, which is more common, is that, well, the Fed is usually dealing with banks. So most of the time whenever it buys anything from someone, it's buying it from a bank. And by something, of course, I don't mean tables and chairs. When the Fed is buying something, it's probably buying the security. So it can just pay, the bank already has an account with the Fed. So the Fed can easily pay them by just saying, okay, plus 10 million in your account. And thus, the Fed has conjured into existence new reserves, thus increasing the monetary base. So, in general, the Fed adjusts the monetary base by buying and selling things. If it buys something, it has to pay for it by increasing one of these. If it sells something, it has to be paid with one of these. And of course, if the bank pays the Fed with currency, then that currency is no longer circulating. If the bank pays with reserves, the Fed just says, okay, minus 10 million in your account. And therefore, there's reserves, there's less monetary base. So there is a name for these things. Anytime the Fed buys or sells anything, we call that an open market operation. Open market operations can also be referred to as an open market purchase if it's the Fed buying something, or an open market sale if it's the Fed selling something. And then open market purchases increase the monetary base, open market sales decrease the monetary base. Interestingly, the monetary base is sometimes referred to as M0, giving you that idea that it's even more fundamental to the monetary system than M1. So now, to see how this is going to work, we need to do two things. One, let's pick an example. Let's go with an open market purchase. And since the Fed is going to be buying some assets, buying something, and as discussed, the Fed generally is going to be dealing with banks. Before we think about the Fed buying a bunch of assets, so I guess we could start by saying, e.g., suppose the Fed buys $10 million of securities. Before we think about the impact this has, we need to actually step back a bit and think, well, why is the bank probably selling securities in the first place to anyone? So we'll have a little side note about, well, what are the banks doing day to day? And then we'll see what happens when they interact with the Fed in this environment. In other words, we have to, as I was saying, we have to think a little about, well, why would the bank be selling securities to the Fed? To do that, let's imagine a bank has some liabilities and some assets. Let's call it GW Bank. And what does GW Bank do? Well, they take in deposits, and then they don't hold all of them on their balance sheets. They try and lend them out, at least to some extent. And so on a day-to-day basis, GW Bank's job is to receive people who are interested in borrowing and vetting them to see if these look like people who are likely to pay back, figuring out what interest rate to charge them, and if they look like good borrowers, then there we go. So suppose that someone comes to this GW Bank, and rather than filling out the entire balance sheet, we're just going to track changes in the balance sheets to make sure that everything remains balanced, whatever we do. That's called a T account because of this shape. So just to make life easier, we'll just track changes. So suppose a GW student comes over here and they say, hello, GW Bank, I would like to borrow $10 million to buy a yacht because I'm, GW grad, I'm extremely successful in my business, and I've decided I want to buy a yacht. The bank looks at your accounts, looks at your employment, looks at your earnings, and says, you know what, I think this is a good investment. This person, I will lend them the $10 million, and I'm confident that they're going to pay me back. So the bank lends you $10 million, so plus 10 millions in loans. And something else has to change, right? Because the bank had to give you the funds. So where do the funds come from? The 10 million. Which item of the balance sheet? Has to come out of the reserves. Right? This is the bank's bread and butter, to identify good loan prospects, and if they find them, well, they have to give them some of the reserves so they can, in your case, go and buy a yacht. Great. But now, GW Bank is in a quandary. They just gave out 10 of reserves. What happened to their liabilities? Nothing has happened to their liabilities. So this bank would really quickly, well, this bank right now is not at its target amount of reserves. It very quickly needs to get another 10 million in reserves. So before the end of the day, because they have to show that they have the right reserves by the end of the day, or because they want to get back to their desired reserves quickly, they will need to somehow replenish these reserves. So what can the bank do? Well, it has two options. One is, as discussed, they could borrow from another bank, right? Let's focus on the other option. The other option is, well, they could sell something. Let's say they sell 10 million in securities. And of course, when they sell them, they get back another 10 million in reserves. So when all is said and done, they gave you the reserves, but then they sold securities, so they got back the reserves. And so when all is said and done, this is what changed. So the bank identifies good loan prospects, gives them funds out of their reserves, but they very quickly have to do something else to get back those reserves, and one of the options is to sell securities. Of course, they might be selling the securities to another bank, in which case nothing interesting happens, but here is the Fed, who's looking to buy $10 million in securities because it's decided it wants a larger monetary base. What happens if the bank sold these securities to the Fed, and the Fed pays them? Well, remember, we just added 10 in reserves there, paid them with reserves. Well, now suddenly there's an extra 10 million in reserves that the Fed paid for these securities. You may be briefly puzzled because we don't see the new reserves. That's because they're not here, because the GW Bank gave them to you, and what did you do with them? You bought a boat. So who has them now? The owner of the boat store. So the owner of the boat store has just received the $10 million from you, and where could they have it? They could have a very large wallet with $10 million in it, but no, they can't do that because we're still in our utopia with no currency. So we're focusing on the dynamics of reserves. So since there's no currency, this person who sells boats, so let's call it Boating Bank, has put it all in their account. So, and of course, in the instance in which this person deposits funds in his or her account, these are, from the perspective of this bank, new reserves. So it's a little complicated, but what happened here again? The bank needed funds. It got them by selling securities to the Fed. It lends them out, and now because once those funds are spent, we now finally have an increase in deposits, which means we have an increase in the money supply. And the reserves, well, they were briefly here, but now they're over here. So we have still an extra 10 million in reserves, and once they're spent, we also have an extra 10 million in money. Okay? Any questions, comments about this first step? Why is this a first step? It's a first step because it's a first step in monetary base converting into money supply, because this bank just got $10 million in deposits. In the instant in which they arrive, there's 10 million in reserves. But banks generally don't want to have a one-to-one ratio between their deposits and their reserves. This bank would like to lend out some of these reserves. Not all of them. How many? 9. 1 minus the reserve ratio times the amount, 10, which is 9. So of course, they can't do it immediately, but they will be on the lookout for suitable customers, so they can lend them 9 and keep 1. Like who? I know, like Georgetown students. They can't afford as big a yacht as GW students, so Anyway, so imagine a Georgetown student comes and borrows $9 million to buy a smaller yacht. And what will happen? The same thing, in the sense that these loans are lent to someone and spent, and then whoever got them, right, whoever was the seller of this smaller boat, now has that in terms of new deposits. And again, that means in the instant in which those funds show up, these are also new reserves. It's going to write another bank. It might be the same bank, actually. It doesn't really matter. So once this bank lends out those funds, 2 things happen. One is that, remember, we had $10 million in new reserves. How many new reserves do we have? We still have $10 million. It's just that it's spreading out as banks hold on to a little bit and then lend out the rest. So slowly, so we started with a sale of $10 million in securities from a bank to the Fed. The Fed performed an open market purchase. At first, all the new reserves were here, but as banks keep lending them out, they're just spreading, and it's sort of hard to say where they are really, just spreading out across the banking system. But still, it's an extra 10 million. But what about money? When this first loan was spent, when these new reserves were spent, we got this plus $10 million in deposits here. But then a bunch of those funds were lent out, and now we have more than $10 million in money. In fact, we have 19. And of course, we're not done yet, because this bank has 9 million in reserves and 9 million in new deposits. It would also like to lend out 90% of this. It only wants to keep 10% of it on its balance sheet. So again, it will take time, but it would like to be in a situation where it has, well, 0.9 in reserves and 8.1 in loans. And then the same thing would happen at the next stage, and so on and so on. So there's several ideas here. One is that, as suggested here, when you change the monetary base, you end up with a larger amount of money supply. We're also seeing why this multiplier is there. It's there because these extra reserves actually get lent out multiple times. Each time they're lent and spent, they generate new deposits. Each crank of the wheel, the amount of new deposits generated gets smaller, and so that suggests that this process of transforming new monetary base into new money supply is gradual. But I guess, but it does explain why it is that this multiplier is there. Moreover, what if instead of holding 10% in reserves, the banks wanted to hold 20. Then this wouldn't be 9, it would be 8. This wouldn't be 9, it would be 8. In other words, if the banks lend less intensively, i.e. hold more reserves, the multiplier would get smaller. You're getting less new money each time you turn the wheel here. Exactly as this would suggest. Right? So now we can see where this relationship, negative relationship between reserve ratios and the multiplier is coming from. If the banks hold lots of reserves, each time this happens, they're generating smaller amounts of deposits, and so the multiplier is smaller. Any questions, comments about this multiplier process? Hopefully this clarifies some of the things that you've already seen in the most recent homework. That's why I decided it was good to talk about it, since we hadn't yet. There's one more thing I can show you, which is that this seems like an infinite process, and I guess it is, although each time we turn the wheel, the additional money generated gets smaller and smaller and smaller. But it would be nice to know that if we took this process to its logical conclusion, that we would end up with a multiplier that looks like this. That would be reassuring. So, why don't we do that? So, the multiplier is a minus supply over the monetary base. Now, what's the monetary base in this example? 10. What was the money supply? There was the deposits generated. Right? The first time, well, the bank got the reserves, made the loan, gave them to you, and you spent 10. Then 90% of that was lent and spent somewhere else. Where did 90% come from? Well, it was 1 minus the reserve ratio. The reserve ratio was 10%, so the remainder is 90%. So how much did we get? We got 10 times 1 minus the reserve ratio. What about the next one? Well, the bank that receives these deposits is going to lend out that number times 1 minus the reserve ratio. So that number is 10 times 1 minus the reserve ratio. And that we want to multiply times 1 minus the reserve ratio, which means it's 1 minus the reserve ratio squared. You can see where this is going. Next stage, same thing. They receive this amount in new deposits. In the instance in which they show up, they receive this amount in new reserves. They want to hold on to 1 minus reserve ratio of them. So we'll get this amount times 1 minus the reserve ratio squared times 1 minus the reserve ratio. So it's cubed. And so on and so on and so on and so on. Notice we can simplify this because everything at the top is multiplied by 10, and then we divide the whole thing by 10. So let's just divide each term by 10. 10 divided by 10 is 1. This is just 1 minus the reserve ratio. This is 1 minus the reserve ratio all squared. This is 1 minus the reserve ratio all cubed. And so on and so on and so on forever. So let's call this n. How are we going to compute this? Well, there's a little trick. I'm going to write here are infinite sum m times 1 minus the reserve ratio. To get this, I just need to multiply each of these terms by that, right? So what's 1 times 1 minus the reserve ratio? It's 1 minus the reserve ratio. What's 1 minus the reserve ratio times 1 minus the reserve ratio? It's 1 minus the reserve ratio squared. Whoops, that's not right. This is right. What's this times 1 minus the reserve ratio? 1 minus the reserve ratio cubed, and so on. Why is this useful? One more step. I'm going to multiply this whole thing by minus 1. So that's minus. That means we just stick a minus sign in front of everything. Right? Why are we doing this? Because we're going to take the top and subtract that. What do we get? Well, 1 plus 1 minus the reserve ratio plus 1 minus the reserve ratio squared, and so on, all the way to infinity. And now let's add these terms. Minus 1 minus the reserve ratio, minus 1 minus the reserve ratio all squared, minus, and so on to infinity. You see what's going on? Each of these infinite terms is going to cancel out with the subtracted term from the second line. In other words, this is 0, 0, 0, 0, 0, 0, 0, 0. This one doesn't cancel out with anything. So we have this. Finally, what can we do? We can factor out m. So m times, well, m divided by m is 1. This divided by m is 1 minus the reserve ratio, so this is 1 plus RR is 1. 1 minus 1 is 0. I shall just write it like that. M times RR equals 1. So, conclusion, divide both sides by the reserve ratio, you get the multiplier is 1 over RR. Just like here. We would hope so, right? If we did all this and we came up with a different formula, that would be unnerving or fishy. But we don't. So we had this formula for the world with no currency that we derived just by imagining what the entire balance sheet of the entire banking system would look like, and we got this expression. What we're seeing now is that we get the same answer if we think about the details of how banks actually lend out new reserves that are injected into the banking system. But it's a slow process because it depends on the banks repeatedly lending out these funds, and of course, banks don't just instantaneously do that. It's telling us that when the Fed decides that it wants to change the monetary base, this expression tells us in the end what's going to happen with that monetary base, but it's a gradual process potentially because it depends on banks having time to lend out those funds. In addition, it underlines once again this idea that the Fed can control the monetary base because they can decide how much to buy or sell, but they don't control this. The banks do. Any questions, thoughts about this process? So, all of this we did in our utopia that doesn't have currency. What happens if we return the currency? The presence of currency doesn't necessarily change anything here. How come? Well, I'm just going to write this here, lends to GW grad to buy yacht. When I paid the yacht seller, the boat seller, in the world without cash, I could only pay him or her with deposits, and so they all show up in their account as deposits. But what if I paid them with a mix of cash and deposits? And they deposited all of them at the bank. Would anything change from our story from before? No. The bank would have an extra 10 in deposits, some mixture of electronic funds and cash, and they would still generate the same extra $9 million of reserves which they would want to lend out. So the existence of currency doesn't necessarily change the story. What will change the story? What if this bank lent me the $10 million, I spent them at the boat store, and the boat store owner, instead of taking all 10 million and sticking them in the bank, decided, you know what, I want to keep some of it in my pocket. What would happen to the multiplier in that story? It would go down, because some of those funds are now leaking out of the banking system and into my pocket, into, well, the boat seller's pocket. So it wouldn't be the full 10 million that shows up in the banks, at the bank as deposits and as new reserves. Some of it's in the boat seller's pocket, so they would not be lending out 9 million. They'd be lending out less than 9 million. And so each time, if people hold currency, then this multiplier process isn't as powerful because a bit of the funds leak out at each step, at each cycle. So what matters for the determination of the multiplier is two things. One is the reserve ratio, and the other one is our willingness or desire to hold cash as opposed to having everything in the bank. So some observations from that. First of all, is there a multiplier formula for that world? There is, but it's a very messy formula because, again, it has to keep into account not just how much currency is there, but how much of it are you holding as opposed to banks. So we won't worry about it. The important intuition is that the more you and I want to hold cash, the smaller the multiplier. So it's, again, one more factor that affects how the monetary base translates into money that's not under the Fed's control, at least not directly. So the next question is, okay, fine, so we've decided that there are two factors that are outside of the Fed's control that might affect the money supply, but do those things ever change much? Let's look at this one first. What might make the reserve ratio change suddenly? Well, remember, the 1 over the reserve ratio is the inverse of, it goes up when banks lend more, it goes down when banks lend less. So could something happen that suddenly changes the bank's lending behavior? Yeah. A recession? Maybe. What might banks do in a recession? Because there's just fewer business opportunities? Maybe. How about even worse? What if there's a bank run? Not all recessions are associated with financial crises, but all financial crises are associated with recessions for sure. So if there are bank runs happening, and I'm a bank, I don't want a run on me. So what can I do to try and lower my exposure to bank runs? which are driven by people who are afraid of losing their funds, I can boost up my reserves and lend less. If I suddenly do that, what happens? My reserve ratio goes up. My lending intensity goes down. Multiplier goes down. What about our willingness to hold currency as opposed to deposits? Could that change suddenly? What if there's a bank run? What if we're afraid of losing our deposits because our confidence in the banking system is low? Then we all withdraw our deposits and hold cash. Suddenly the banks don't have that cash anymore. They can't multiply it. Multiplier goes down. So both of these things, the recession is a bit more broad, but the bank run financial crisis story, of course, is a bit more specific. So what I wanted to do was to show that this discussion is not just academic. There have been instances where the monetary base changed dramatically even though the Fed wasn't doing anything. And so this slide, as you can see at the bottom, it says M1 and the monetary base 1929 to 1923 in the United States. So this is the period known as the Great Depression. So there are two lines in this figure. One, well, the x-axis is years, the y-axis is billions of dollars. The bottom line is labeled monetary base. And what does it do over this period? I would say not much. It's fairly flat. It goes up a little towards the end, though, then it comes down again. So I'd say the monetary base isn't really doing anything. What's the Fed doing? Nothing much. Then there's this upper line, which is labeled M1. And what do we see? That, over this period, goes down. In some places, pretty steeply. So that emphasizes this idea that the Fed doesn't fully control the money supply. It can move quite a bit. It's gone from 26 down to like 18 or something over a fairly short period of time, even if the Fed isn't doing anything. So there must be other factors at play. And after today's class, if not before, we now know what they must have been. It must be either the bank's lending intensity declined, or people were drawing their money out of their banks, or both. And of course, there's a big hint here, because there are these two dots here that are labeled start of first banking crisis, and these other two dots that say end of final banking crisis, suggesting that there was a banking crisis going on, and suggesting that the kinds of behaviors we just discussed might have manifested themselves over this period. So now here is another figure to try and give us a picture into the behavior of people and banks over this period. First, again, let's start with the bottom line, which is labeled E. E is the excess reserves ratio. So you can see that at the beginning, 1929, 1930, it's close to zero. And this is the way it used to be until around 2008, that there was a required, so excess reserves are reserves that you hold beyond what's required. And it used to be the case that, in general, banks didn't hold excess reserves. They would hold what was required and as little extra as possible, because they'd rather lend it or use it to buy securities. You can see the excess reserve ratio is about zero, and then suddenly in 1932 you see it shoot up. So what are the banks doing? They're suddenly deciding after 1932 they want to hold a lot more reserves than before. So they're trying to deal with their exposure to the banking crisis. So we said the multiplier is inversely related to the reserve ratio. This is consistent, right? We know the money supply was dropping at that time. We see the reserve ratio was going up. But there's still a puzzle. because the excess reserve ratio doesn't do anything until 1932. The money supply is dropping before that, right? So that can't be the only story. In fact, it can't be the main story, because something else must have happened first. In fact, maybe something that prompted them to want to have more reserves. So, what's this second line? The second line is C, currency ratio. What's the currency ratio? It's just currency divided by deposits. That's all. So if the currency ratio goes up, it means there's either more currency or fewer deposits. Now, if you were in the middle of a banking crisis and you're a bank customer, what might you want to do? Like if you're afraid of a bank run happening at your bank, you would be withdrawing cash, which is the numerator, right? Currency over deposits. So that's maybe going up. And withdrawing your deposits. So that's going down. So either way, if people are panicking and closing their accounts and taking out cash, that number C should be rising. And again, of course, that reflects confidence in the banking system, or lack of confidence in the banking system if you're shutting your account. So you can see this C exactly starts rising around where it's labeled start of first banking crisis. So what's that telling us? It's telling us that that was the real problem in terms of the Fed not being able to control the money supply. There started to be bank runs, people started to close their accounts because they preferred to hold cash, and eventually, after a year or so, the banks reacted to this by holding more and more excess reserves. And again, over this period, what did we see? We saw that the Fed didn't do much and the money supply declined. Should the Fed have done something? Well, what happens if you have the money supply declining? What would you expect to happen? Well, things that are scarce generally increase in value. So that means the money becomes more and more and more valuable, which means prices drop. Money is becoming more valuable relative to everything else. It's the same thing as saying that the price of everything else in dollars goes down. In other words, deflation. And there is this idea that when there is serious deflation, there is no, like it will erode people's desire to buy things because, tomorrow's going to be cheaper. Why don't I just hoard cash and wait for tomorrow's cheaper price before I buy anything? And by this logic, what it means is that when there's deflation, you get this sort of collapse in aggregate demand. Hence the Great Depression. So many look back on this and say the Fed should have just been printing money here, just to try and stop the money supply from collapsing in this way. But they didn't. And so that's why this discussion today of factors that might affect the multiplier is important. It's not just an academic matter, but when financial crises occur, the impact that it has on the aggregate economy can be very significant. Any questions, thoughts, or comments about this story? So, what did we do again? We did several things. We linked monetary base to the money supply. We did it twice. We did it once by just looking at the balance sheet, and then we did this more detailed multiplier process together. And we found that we ended up with the same multiplier that way. Then we added currency back into the mix to see how that changed anything. What it told us is that there are two factors that affect the multiplier. And we saw with data from the Great Depression that this is actually a thing. So we have about 10 minutes left. So how about one more exit quiz? All right, let's get cracking. First question. Excess reserves are reserves that the bank what? Is required to hold, doesn't want to hold, holds beyond what is required, or needs to meet its requirements. Of course, the answer is holds beyond what is required. If a bank lends 10 to a customer, what happens? Do its reserves decline by 10, increase by 10? Does its bank capital decline by 10, or increase by 10? If the bank lends 10 to a customer, its reserves decline by 10, because there's nothing else for them to give them. If the bank has insufficient reserves, what can it do? Sell securities, buy securities, decrease its borrowings, or pay dividends? And the answer, of course, is sell securities, because they need cash. If a bank sells some government bonds to someone, what happens? Do its liabilities increase or decrease? Or do its assets increase? Or do its assets stay the same? Its assets stay the same because it gets paid back in cash. And last one, when the central bank buys bonds, generally what? Use your intuition of supply and demand in the bond markets. What would happen to bond prices? What does that mean about interest rates? Interest rates will fall, which is what we'll discuss when we get back. All right, let's see how we did. Mayor is third, nice work. Nico is second, and first is Thomas. All right, Thomas, come up to the front if you want. I have a little something for you. Everyone else, hope that was useful. See you next week at the midterm. Feel free to write to me if you have any questions or concerns before then.